Hey, how you doing today? We're going to talk about one of the most important pieces to help you purchase rental property. Now, the most important thing to qualifying for a normal mortgage is your debt to income ratio. Now, most people think that it's really related to their credit score. They think I've got great credit, so I can get a loan. And that's just not true. It's important, but the most important piece is your debt to income ratio. And that's your monthly debt payments divided by your gross income. Now, not your net income, your gross income before any deductions. So yes, if you earn $50,000 a year, you're gonna get taxes and all kinds of stuff taken out of it. You probably earn $35,000. But for your debt to income ratio, they care about the $50,000 number, not that $35,000 you're actually getting. So you take your monthly debt payments, which is everything that would show up on your credit report, like your car payments, credit card payments, student loans, any mortgages you might have. All those things go towards your monthly debt payments. And then you've got your gross income. And then you do the math. Now, generally when you're trying to qualify for a loan, it depends on the loan program. But you want somewhere between a 0.35 and a 0.50 as your ratio. So that means between 35 and 50% of your income is taken up by your debts. Now that's including the mortgage for the property you're trying to buy. So really, you want your monthly debt payments to be a lot lower in order so once you add that mortgage payment in, that now you're still underneath that ratio. Now here's the thing. There's a couple ways to get this ratio working better for you. You can earn more income or pay down your debts. So we're going to start by talking about paying down your debts because that's what most people start thinking about. And then I'm going to talk about how multifamily and rental property can help you increase your income and also help you qualify. So first, we're going to talk about paying down your debts. There's a couple different methods that people generally talk about, but I'm not going to talk about any of those. I'm going to talk about something that's focused specifically on real estate. And so the way that you're going to determine how to pay down your debts, and the best way to pay down your debts is we want to see how we can reduce your debt to income ratio the fastest. And that's not based off of interest rates. It's not based off of which ones you can pay down fastest. It's based off of which one reduces my monthly payments, right? Because this is about monthly payments. Now, a lot of people say, reduce the interest rate first, right? And that makes sense. If you've got an 18% interest rate loan and a 5% loan, you should probably pay off the 18% one first because you're paying more interest. But that may not be true. What if the one with the 18% interest rate only has a $20 payment and the one with the 5% interest rate has a $200 payment? Which one do you think affects your monthly debt payments the most? Obviously, the lower rate. In this example, it could be flipped, but in this example, it would make sense to lower this faster, you pay this one off. So we want to figure out how to pay those off the fastest. So here are a couple examples. Let's just say, here's the balance, here's your monthly payment, and then the ratio is simply dividing this by this. 3,500 divided by 350 is 10. So that's all this is, right? So let's just say you've got what's left over of your car payment. Maybe it's almost all paid off. You've had it for 3 or 4 years. You've got a little bit left. That's why the payment's high, but the balance is kind of low. And then maybe you have a student loan. And maybe this is a credit card. Okay. So your payment here is $350. This one's a student loan. You have $7,000, but it's got a little payment, $125. And your credit card is $2,500, and let's just say your minimum payment is $150. When you do all the ratios, you get 10, 56, and 16 here. Okay. Now that ratio doesn't mean anything to you yet, but I just want to do this out. We chart it out like this. Now, what this ratio really means is how many dollars do I have to pay for every $1 I reduce for my payments. So in this one is every $10 I pay, in theory, it takes me, for every 10 bucks I pay, I reduce my payment by $1. Now it doesn't obviously work out that way because you can't just pay 10 bucks and they lower your payments. Usually the payment's fixed on something like that, but it's to get a ratio. So if I pay $3,500, I've removed $350 in payments. On this one, it's for every $56 I pay, I reduce my payment by $1. So for every 56 bucks I'm paying towards my student loans, I'm reducing my overall monthly debt payment by $1. And that's what this means. So I have to spend a lot more here to get the same reduction on payments. That's what this alternative method is. So what you want to do is start with the lowest ratio and pay that one off first, and then pay the next one off, and then so you do it in that order. So if paying off this one here qualifies you, then you don't need to go ahead and pay this one off and this one off. And you just keep working your way down the list here, and then if you might have 6 or 10 of these going down, and you're going to just keep working your way up from the lowest ratio up to the highest ratio until you've paid off enough debt that you have achieved the monthly debt to income ratio that you need in order to get the loan. So that's one method to do it. The other way to do it is to increase your income. We're going to try to increase our income. Now, you could go to your job and try to get a raise. That's one way to do it. But an interesting thing is that rental property helps you. Let's say you buy a 3-family, right? Say you're going to buy 3 units. Now, just to give a little bit of numbers that go with it, let's just say you earn $10,000 per month. That's your monthly income for your family, you and your spouse or whatever, or just yourself. And let's just say your monthly payments are $2,500 right now before you purchase your next property. That's 25%. So you say, oh, great, I'm qualified. I'm underneath these numbers. Well, you're going to add in your mortgage, whatever that mortgage is. Let's say the mortgage is $3,000. Okay, just to go with the example. So that would put you at $5,500, which is 55%, which is above your ratios. You're not going to qualify. So what we got to do is you can pay down these debts like we talked about in the other example, or we can increase our income. And that's why if, let's say you buy a 3-unit and you're going to live in 1 unit, that gives you 2 other units of rent. Now let's just say the rents are $1,000 per unit. That's $2,000 in income. Generally, your bank is going to take some portion of this, not going to take the whole amount. And it can vary from bank to bank and lending program to lending program. Let's just say it's 75%. So that's $1,500 added to your income. Okay. So now your income is $11,500. And just real quick math on that. We got 5,500. I got to use this calculator because I'm using my phone to record this. That is a 47.8%. So now you may be qualified. You might be qualified, depending on the loan program. If you get a loan program that allows you to have a 50% ratio, you may be qualified because you've reduced your debt to income ratio simply by getting a 3-family instead of buying a single-family rental. So now that would be even more beneficial, right? If you had 4 units, you could have even another $750, which lowers that ratio even more. Now, this only works for a rental property 4 units and under. 5 units and over is considered commercial, so you can't do this method with it because commercial lending is totally different than typical residential lending. So this is how you use your debt to income ratio and you manipulate it in order to help you qualify for a mortgage. And this is the most important piece, is understanding how to manipulate both the numerator and denominator in order to help you get your goals, achieve your goals, and get your mortgage and get that rental property. If you don't know how to play with these numbers, then you may not be able to qualify. So you just got to learn how to manipulate it. Do what you need to do in order to get that loan. My name is Eric Bolin from idealrei.com, and if you like this video, I want you to subscribe right now. If you want more real estate education to help you achieve financial independence with real estate investing.